Welcome to The Explainer. Today, we are piecing together a pretty complex puzzle in the global markets. We're trying to figure out why India's stock market seems to be on a tear while Wall Street is flashing red all over the place. And what does the explosion in AI have to do with any of it? Let's connect the pieces.
So you look at one side of the world and you see a whole lot of green. Indian markets are climbing. But then you look at the other, and whoa, it's a completely different picture. It's a wall of red as US markets take a pretty significant tumble.
Now, what is going on here? This huge difference, it's not just random, it's not just a bad day in New York. We're actually seeing a story of two economies on totally different paths, a big shift in where investors are parking their money, and this tech revolution that is basically rewriting the rules for everybody.
All right, here's our game plan for how we're going to break this all down. First, we'll look at that stark contrast between the two markets. Then we're going to dive into what's really fueling India's rally. After that, we'll see why investors seem to be running for cover. Then, the big one, the AI disruption engine. And finally, we'll tie it all together and talk about what this actually means for you.
Okay, let's start with the big picture, right? This clear contrast between these two major markets. So if you look at India, the picture's pretty rosy. The Nifty 50, that's the main benchmark, is up a solid 0.6%, and you're seeing similar gains pretty much across the board. It's a sign of real confidence over there, even if the mid-caps are trailing just a little bit.
Now flip over to the US and man, it's a totally different world. It's pretty brutal, actually. The Dow dropped over 1.6%, but the real story is that last number. The VIX, that's Wall Street's fear gauge. It jumped more than 12%. That's a huge spike, and it tells you investors are genuinely spooked.
Okay, so what is actually going on inside the Indian market that's pushing it up? Let's peel back the layers and see who's really winning and who's getting left behind.
The thing is, the overall market might be up, but that doesn't tell the whole story. There's this massive tug-of-war happening just beneath the surface. It's really a battle between a few stocks pulling the index higher and a bunch of others trying to drag it right back down.
So on one side, you've got these financial heavyweights, right? HDFC Bank. They're doing a lot of the lifting. But then on the other side, you've got big tech and industrial names like Infosys just acting like an anchor. This tells you the rally isn't some universal thing. It's really concentrated in just a few key sectors.
And you know, it's a great reminder that even in a strong market, individual companies can be in a world of hurt. I mean, take BPCL. Just got slapped with a massive tax bill out of nowhere. It just goes to show, you always have to look past the big headlines.
So with all that red in the US and that fear index spiking, it's really no surprise that investors are running for cover. And that brings us to the classic flight to safety and what that looks like in the commodities market right now.
When stocks get this choppy, investors often run to traditional safe havens. And right now, gold is absolutely shining. A single-day jump of nearly 2.5% is a massive, massive move for gold. And check this out, this is not a one-off spike. Gold is up over 7% in just 4 days. That's not just a little bit of buying. That's a stampede. It's a clear signal that the fear of economic trouble is very, very real.
And it's not just gold either. Silver is also surging, up over 3%. And at the same time, the yield on the 10-year US Treasury bond is climbing. When that happens, it often means investors are getting seriously worried about future growth and inflation.
But here's the really crucial part. None of this is happening in a bubble. It's all playing out against the backdrop of probably the biggest technological shift we've seen in a generation, the rise of artificial intelligence. This quote from a recent research report just lays it out in really stark terms. It describes what they call a displacement spiral, this cycle where AI gets better, that leads to layoffs, the savings from those layoffs fund even better AI, and on it goes. It's a feedback loop that could fundamentally remake the entire job market. And here's why this is a potential economic bombshell. AI is no longer just automating simple tasks. It's coming for high-paying, white-collar jobs. And since the top 20% of earners are responsible for almost 2/3 of all consumer spending, significant job losses in that group could slam the brakes on the entire economy. Hard.
And this isn't some far-off future we're talking about. It is happening right now. An AI called Claude can now write COBOL code. That's a direct shot at IBM's lucrative mainframe business. Meanwhile, OpenAI is projecting massive revenue growth while also burning through billions. And it's teaming up with the world's biggest consulting firms, a move that could ultimately disrupt the consultants themselves.
Okay, so We have a rising Indian market, a falling US market, a rush into gold, and an AI revolution. How do all of these pieces actually fit together? Let's connect the dots.
It really boils down to three key things. First, global markets are no longer moving in lockstep. Second, this uncertainty, especially the kind kicked up by the AI revolution, is causing a classic flight to safety. And third, the engine driving all of this long-term change is AI, which is creating a new economic reality right before our eyes.
And that leaves us with a critical question, doesn't it? For decades, companies have built their competitive advantages, their moats, on complex processes that required lots of people and coordination. Think of consulting, law, or even parts of finance. As AI smooths out that human friction and automates complexity, which of those fortress-like businesses will be the first to crumble? That's the billion-dollar question every investor and employee needs to be asking.